let's get started. Welcome to this session of the Future of Finance Conference. My name is David Bach. I'm Senior Associate Dean for the Executive MBA and Global Programs here at Yale School of Management. And I'm thrilled to be moderating this panel. Many of you know Will and Geert very well. One of the wonderful things about them is they give you these very small, manageable assignments. Mine was to work with a panel that they had already put together on the changing role of finance in the world. And I asked Will, but what part of the world? He meant, no, the world. But I'm not that nervous about it because we have a terrific panel of experts whose expertise covers quite literally the world. Three of them are Yale alums. So we're, I think, well prepared to take on this challenge. Let me introduce our panelists briefly to you. You have more detailed biographies in your conference materials. Teresa Barger is the co-founder and senior managing director of Cardicar, and she had previously spent 20 years at the International Finance Corporation, where she led a lot of their efforts in the area of financial market development and what we're now referring to as emerging markets. Paolo Zannoni, sitting next to her, is chairman of the Italian Investment Banking Division and CEO of Goldman Sachs in Russia, and a frequent flyer between Milan and Moscow. Eddie Tam, sitting next to me, is chief executive officer and chief investment officer of Central Asset Investments, a firm that he founded in 2005. The format for this session is really interactive. I want to ask each of our panelists a lead-in question, but we're hoping to open it up very quickly to all of you, and I look forward to your questions and your contributions, because the question about how finance and its role in the world is changing, and as importantly, the role that finance plays in addressing and perhaps solving social challenges is really something that can benefit from everybody's insight. Certainly with such a distinguished audience, we look forward to your contributions to this. So, Paolo, let me start with you. I know that you believe strongly that financial institutions have a big impact on the political, economic systems in which they operate. And in fact, you come to SOM at least once a year and you actually lecture on this topic in our State and Society course, the interplay of financial institutions and government policies. So certainly financial institutions and their design have been an important piece of government policy in the past, but is that still the case, or are we beyond the phase where governments sort of specifically use the design of financial markets and financial institutions to drive political objectives? And can you give us some examples if you think that this is still happening?
I will try. No, I believe that the role of financial institutions in society, and especially with their relationship with government, is very important everywhere. And I will try to give you some examples or some recent developments in the three areas where I work. In the three areas I would consider Russia first, because the most difficult one. Italy second. I'm Italian, and so for me it's a lot easier to deal with Italy than with Russia. And Europe third, because it seems to me that some of the developments in Europe, especially when financial institutions are concerned, are very important and go to the heart of what we are discussing today. With Russia, I have to say one of the major characteristics, I would say probably, of Russian capitalism is the integration between, or the strict integration between financial institution, oligarch, and the political power. And I would say that probably recently the trend has been toward more integration than toward less integration, or at least more influence than less influence, with one potential development that is very recent and where we will see the way it goes, but it could have a significant effect, and is probably the only good news coming out of or that might be good news coming out of Russia recently, which is that the Russian government has reformed the asset management, the pension fund industry. And it has reformed until 2014, from 2002 to 2014, the pension fund industry, the pension funds in Russia were practically divided in two. 40% of the pensions were private, and 60% were a restructuring or the leftover from the Soviet government. But these funds could not invest in equity. They could only invest in fixed income. And when fixed income is in an enlarged sense, fixed income was also bank deposit. So actually, as you can see, the pension funds were, one, small in size, and two, they were actually supporting the system and not entering into the capital market play in a significant part. With the new reform, most of the development is going to be in the private sector, and the pension funds are going to be allowed to invest in equity as well, mostly Russian equity. And so, assuming that there is a semi-market oriented development, that's probably going to create an independent pool of capital that it's not directed by the oligarch and or by the traditional financial institution, and it will probably go into the equity market. And that's potentially, I think, probably the only potential good news coming out of the Russian financial system lately. This is a reasonably recent development. If we move to Italy, which is easier, for me at least, I would say that as far as financial services are concerned, there is one very good news coming out of Italy, which had been held up for, I don't know, the last 40 years, which is Italy has, in Italy, the structure and even the corporate governance and the ownership of the banks and the financial services industry is decided by law. And it has, traditionally, Italy has a several-tiered structure of financial institutions. And when you go to the large commercial bank or universal bank, you have joint stock companies, but you also have popular bank or cooperative bank that are very significant. They are about 25% of the total asset, and Italy has a big financial services industry. The law on this cooperative bank or popular bank has been recently changed. This was one of the few reforms that the Prime Minister was able to get through Parliament, and they are going to be turned into joint stock company. And so actually the three-tier or the two-tier system is going to be eliminated, and the inefficiency and the closeness and the clientele characteristic of this cooperative bank should be broken, and they should be open to the international capital market and your usual institutional financial investor. And so I think this is very good news. I would say I've been around the Italian business environment for more than 35 years, and there always been talk about reforming the structure, which is very obsolete and very inefficient. And for the first time, for the only time in which the law has been approved, it was able to beat the lobbies in Parliament that have always thwarted every attempt to reform it, because as you can imagine, 25% of the asset, or 25% of the banking asset managed in a closed way together with the leaders of your business community in the region, it tends to move a lot of interest and a lot of lobbyists, but this time they lost, and the reform was approved, and I think it will mean a significant change in the financial industry in it. I will stop here because if not, I take too much time.
But it sounds like, if I can just ask a very quick follow-up, that in this particular case, the reform of financial institutions isn't just about making the financial system work more efficiently. There's a political agenda here as well in terms of industrial policy,
See,
corporate control.
I don't want to take up too much time, but again, in Italy, everything that has to do with financial services has always been decided by special laws. And you should not consider special law like in the US, where you try to regulate what can be done and what cannot be done and what the capital is going to be. When I mean special law, I really mean special law, and even the civil code is suspended, and the corporate governance rule and the ownership rule are ad hoc made for financial institutions. That has been the history for the last 100 years. And so the reforms are made reforming everything: capital structure, corporate governance, products, and votes. So,
Eddie, if I can move to you, I mean, clearly if we're thinking about the relationship between government and financial markets, financial institutions, from where you sit, there's no way around it. I have to ask you about China and your perspective of what is happening there. And you know, what is your assessment of this situation, and specifically, not so much the turbulence itself, but perhaps some of the underlying reasons? So are we seeing, you know, domestic developments in China shaping global financial markets with lots of repercussions around the world and lots of emerging markets? Is this sort of an inside-out perspective that is most helpful, or are we actually seeing sort of global financial trends sort of, you know, forcing the hands of the Chinese government, and sort of the outside-in perspective is more helpful to understanding what is happening?
Well, I'm very honored to be on the panel, and I'm very happy about coming back to SOM. And before the panel, actually, I had a chance to catch up for 30 minutes with Professor Stephen Roach, who is, you know, really a long-term bull on China, and also obviously, you know, expert in China, and also, you know, obviously know the American system very well. And I think he shares my sort of at least short-term concern about China right now. I think the current administration, first of all, is extremely popular with its own people, which is good. But I think the perception is now diverging between the outside perspective and internal perspective. And I think a lot of people who have been working in China for a long time, including myself, have, you know, I think have not seen anything similar to the recent events. I mean, I think it's, to be very honest, I mean, it's really seldom. I mean, China has a very short history in capital markets, right? Like 25 years. You know, I think the government has never tied itself so closely, you know, in terms of their own prestige and face and you know, and their own credibility to the level and to the fortunes of the markets. So that's quite incredible. So, you know, after the market's going up 150%, I mean, it's no surprise that they will have a correction, right? And China has seen many boom and bust cycle before. So the question that everybody's asking is why the government is so keen on intervening so early, so at, you know, supporting the market at such a high level, and in a manner which is so, in their own terms, so violent and so vast in magnitude. I mean, by most people's estimate, they have already spent upwards of $200 billion US in supporting the stock market itself. And I think, no doubt, that's kind of like a you know, immediate catalyst for the even, you know, I think to the rest of the world, the biggest shock is obviously the devaluation of the yuan. It's not very big, it's about 3%, but nonetheless, that's the contagion effect, because China was still a relatively closed system. So a lot of the domestic adjustments, you know, be it tackling the debt problem that is growing or the stock market gyrations, none of that necessarily affects the rest of the world a lot. But you know, it's not like a Lehman Brothers, right? The interconnection between the Chinese financial system and the rest of the world is not very great. But the contagion effect comes from the renminbi. So once they started devaluing, of course, from the Chinese perspective, they were not the first mover. They say, well, US has been doing QE for 5-6 years, and then the yen has been going down, the euro started. So they were not the first one, but they are kind of the 800-pound gorilla in the room. So because they're the #1 trading nation in the world, so therefore when China makes a move, like it or not, the world is extremely sensitive. So recent data shows that may not be constant, but basically 1% move in renminbi, the global equity markets, as measured by, say, MXWO, the MSCI World Index, drops by about 3 to 4%. So the sensitivity is huge. So if we are really going to go on the path of a competitive devaluation, well, we're in trouble. The world is in trouble. And your question is very good. Is it the China affecting the world or the world affecting China? Obviously, the answer is both. So a lot of people say now, are the events similar to those in 97, 98, similar to the Asian financial crisis? Well, the answer is yes and no. The good part, that's the point made by Professor Roach earlier to me, is that obviously all the Asian countries and even other emerging markets, even Russia, even Brazil, have much more foreign currency reserves as compared to 97, 98. Even China in particular has grown from just over 100 billion to now, of course, famously at the peak 4 trillion, and now it's back down to 3.5 trillion. That's still a lot of money, 3.5 trillion. But there are people who are worried that China would run out of reserves, believe it or not. And they're also having a current account surplus of now roughly 60 billion a month because of the drop in commodities and oil. So they're running on an annual basis something like 700 billion of trade surplus, roughly double that of Germany, which is already a very strong export nation. So theoretically, there should be upward pressure on the renminbi, not the other way around. So why are they facing this problem? Well, I think it's because of the bungling of the market rescue operation. So they obviously had to find the money somewhere. Where do you find 200 billion to buy the stock market? Well, either they diverted money from other projects or they printed some fresh money for that. So I think that must be part of the issue, is that the rescue operation precipitated the devaluation of the renminbi. And also, most importantly, is that this year China wants to join what I call almost like the financial World Trade Organization. So China joined the WTO back in 2001. Then that was wonderful for China. It catapulted China to become the world #1 trading nation by 2013, ahead of the USA. And obviously it also helped to upgrade, to grow the manufacturing and exporting industry. But now China wants to become obviously more services-oriented and lessen its reliance on manufacturing and also on investments. So I think it's inevitable that they have to develop the capital markets and financial services industry. So in order to do that, they're trying to do 2 things this year. One is to make a bid for the A-shares market to join the MSCI indices, which they've been rebuffed temporarily. They were told that they have to study it a bit more before they'll allow them to join. Likely they will join, but probably in 6 months' time or in another year's time. The bungling of the market intervention doesn't help their cause, obviously. And the other one, which is even more important, is not yet decided, but it's upcoming, like in December or November, is to try to make a bid to have the UN join the IMF special drawing rights basket, which now currently is composed of the dollar, euro, yen, and the pound sterling. If they make it, and the decision, this one is like the Olympics, they only review it once every 5 years. So if they don't make it, then they have to wait 5 more years. So they've been rejected last time already. This time, I think Christine Lagarde has made all the signals saying that they likely will be able to join, but with the caveat that the actual implementation will be pushed back from next January to at least October of next year. And secondly, of course, the weighting may very likely be very light, very low. But it's symbolic. I think this is, like I said, this joining the global financial system. But there lies the problem. After the stock market crash, and in the guise of trying to join the SDR, they changed the mechanism for fixing the renminbi on a daily basis. So they kind of started to open the capital account a bit more, and thereby violating the so-called impossible trinity. I think as stated by Robert Mundell, saying that you cannot have 3 things together: an open capital account, stable exchange rate, and independent monetary policy. So obviously China is slowing down, as everybody noted. So they need to cut interest rate, which is significantly higher than the US rates, and they need to cut it to stimulate the economy. So previously, the yuan was loosely pegged to the dollar. So they want to cut that tie ahead of the impending rate hike in the US. So you violate the conditions. So if you cut rates, you open the capital account, there will be downward pressure on the yuan. And of course, the timing is horrible after a stock market crash. And the Chinese all believe that the government is pretty well omnipotent. Whether it's true or not is a different issue. So for 10 years, they managed the yuan very well to creep up gradually. So everybody believes that now the government wants the yuan to gradually depreciate. So you're causing a self-inflicted wound. So everybody wants out. It's not the foreigners who now want out, but the local savers, investors want out. So suddenly you have ironically, the biggest saver in the world, you have a capital flight problem on your hand. So 2 days ago, they just announced the latest data on the foreign reserve. The estimated range of decrease, was from 70 billion to 200. Goldman was the bear. Goldman said 200. Morgan Stanley said 70. It came out closer to the better end. Officially, it decreased by a little bit over 90 billion. So at 90 billion a month rate, you would think they'd still be okay, right, with 3.5 trillion reserve. But then there are other scaremongers like Citigroup and so on who say that, well, China needs at least 2.5 trillion to be stable. According to IMF, if you have an open capital account, then you need a certain amount of reserve for a developing country. So by that account, they need 2.5 trillion. So the cushion or margin is like 1 trillion. So if they were really losing 200 billion a month, then you would fritter it away in like 4 or 5 months, which is kind of crazy. But if you were a closed capital account country, then the Chinese have 230% of the necessary reserve. If you're open, then they have 150%. So I think China is really still closer to the close end of things. So they still have a comfortable margin of 230%, maybe 200% of the necessary reserve requirement. So I think some of it is just temporary, loss of confidence. So in my humble opinion, I think the Chinese should stop intervening in the stock market, first of all, and the priority is to stabilize the currency, because the worst outcome would be like a currency war with the rest of the world. And not only then will the situation resemble, 1997 or even 2008. If you look at the domestic debt problem of China, some would say that is worse than U.S. But actually, almost all the debt is internal, and the central government debt level is very, very light. It's 22% of GDP. They have ample ability to absorb the losses of the banks, SOEs, and local government if they choose to do so. And I suggest that they should do that as quickly as possible, again, before they really open up the capital account. And I think, but however, the really worst outcome possible would be like a repeat of the 1930s. First you may have, wrong-ended policies by the Fed or even other central banks, plus then you devolve into like a currency war, like a trade war. Professor Roach actually just spoke now to me and said that he's quite worried that the U.S. will slap cyber espionage-driven sanctions against China this week. So I think then you're asking for tit-for-tat retaliation, and that would be quite bad. So in conclusion, I think right now, if I were the Fed, I would raise rates once. Why? Because I think that demonstrates leadership. But the reality is that China has grown up a lot. And EM back in 97 was just 35% of the global GDP. Now it's 52%. So like I said before, the yuan was pegged to the dollar. But I think inevitably in the future, we'll see that in a sense, even the dollar is pegged to the yuan. So if they cannot raise rates now, then we're entering a whole new, new world. If they raise rates, then we're still facing deflation, right, in the developing markets. Chinese yuan going down is deflationary because that means that demand is lower. Dollar, if it goes down, is actually inflationary because all the commodities are traded in dollars. So conversely, if dollar goes up along with the interest rate, that would be deflationary. That's not a good outcome, but at least that's the devil that we know. But US admits that it cannot raise rates, partly because of what the Chinese have done. Then we're entering a whole new regime. That nothing is stable. Maybe oil will suddenly shoot up $20 a day, or the US markets will shoot up 200 points. if the US suddenly announces that they're not raising rates. But what if the Chinese and then the Japanese and others reacted and they further devalue the currency? Then suddenly maybe Dow would drop 500 and then oil would go down $30. And even gold may or may not be a haven. So that's kind of like the devil that we don't know. And I think that's the kind of scariest outcome if we don't manage it well.
So thank
Sorry.
you for this.
That
No,
silenced
not
the
at all.
audience, right?
I mean, that was, I hope everybody took good notes. So I mean, you spoke so eloquently about the way, you know, China is influencing international financial markets, and one of the terms that you use is sort of China's integration into the world financial system. And if you look at the last 20, 25 years, one of the big stories is how many countries have become part, or whose economies have become part of the world financial system. And in many respects, that's where a lot of your work was at the IFC, helping countries to reform their financial system, financial institutions, with an eye to the implications and the opportunities for economic development and social improvement. And you know, it sort of seemed like a lot of these countries were adopting, you know, Western-style regulations, sort of perhaps wholesale, sometimes at the guidance of, you know, the IFC, other institutions. But listening to Paolo, listening to Eddie, things are pretty exciting in emerging markets. So where are we with this sort of financial reforms in emerging markets? What is different about emerging markets from a financial system perspective from perhaps some of the established markets? What are some of the key variations? So as somebody who's really had a career in building and investing in emerging markets, how do you think about emerging markets from a financial perspective?
Well, it's a big question. So first of all, I'm delighted to be here and to be back at Yale and in the new building for the first time. In terms of the financial sector, the first thing I would say about the emerging markets is that most of them are closed unto themselves, in that there's a regulatory ring around the biggest part of the financial system, which is the banks. And so you don't really, with the exception of 2008, which was a developed market problem that upset the whole world, you didn't really have contagion from emerging market banking system to another market's banking system, because they have this regulatory ring fence around them. So as a global investor in emerging markets, I can have investments in banks in 5 countries, and they will have zero correlation to one another. If I have 5 investments in copper mines, they'll be very correlated to each other. So there's a world price of copper. But here we're talking about domestic savings and domestic lending. The thing that's most striking about emerging markets banks is they actually do banking. They take money from savers and they lend money to borrowers, and punto, that's all they do. Now, the sad thing for me, having worked in it for so long, is the big problem years ago when I started was that there was not a lot of tenor transformation. And so companies could not borrow for more, when I started, probably for more than 6 months or a year. And sadly, they still can't borrow for very long. So this is where the development of capital markets have come in, and developing local currency bond markets was something that was very big on our agenda and has been a very big change from what Eddie was talking about in 1998 when you had the Asia crisis to today, where in the Asia crisis, the real issue was that people had borrowed dollars, and the dollar strengthened all of a sudden, and they couldn't pay back. Today, most of the borrowing is in local currency, and we actually have another problem, which is that US pension funds, for example, will have invested in sovereign debt in local currency of, name a country, Colombia, and now they're going to get paid back in pesos that are worth half of what they thought they were. So that we have that other problem. But the development of local capital markets, I think is fairly important, and what we do try to do as activist investors in the emerging markets is work with companies to make them ready to take international equity capital, because a lot of them just are clueless, right? They don't understand, and they don't understand you can get a very big premium from going from being a company that does not provide a lot of transparency and disclosure to one that does. In fact, I don't know, Lucian Bebchuk's work in the US showed that US companies that were more transparent in the 1990s fetched a big premium, but by the 2000s it was gone because they were all providing that level of transparency. But in emerging markets, because we still have that arbitrage opportunity. I can say more on the financial, but I don't want to, that's not my main thing, so.
One of the things that I know that you were interested in, or that you pointed out, was that there's a really important distinction between, the laws in the books and what actually happens in terms of enforcement.
Yeah.
And Paolo started out by talking about, in Russia, politics and financial institutions go together. You talked about how the government is intervening. So help us understand perhaps a little bit of how you size up the role of the government in enforcing and influencing.
Ian Bremmer has a shorthand where he says that emerging markets are countries in which politics is more important than economics. I would go farther, but it's less catchy, and say emerging markets are countries that have shallow and insufficient institutional basis. And it's that lack of institutional depth that is the key thing we have to work around as investors in emerging markets. And one of the forms that takes is enforcement is terrible. So you might have good laws on securities laws, for example, but no enforcement of insider trading. So there have been a couple of prosecutions in Brazil. There have been some kind of silly things in India. They had a big all India rush when Satyam had a fraud, and they really rushed in and did their thing. China is absolutely, sorry to say, but you may agree with me, heinous on corporate governance. And so people who were tunneling, asset stripping, robbing minority shareholders of business opportunities, stealing inventories, having false accounts, those people didn't go to jail. But now we're seeing a lot of activity where they're going in with a heavy hand on short sellers, making people, journalists self-confess, et cetera. So it's the unevenness, the unpredictability of enforcement that I think is hugely difficult for us. And whenever I'm in the listed markets now, but at IFC, when we did contracts, your contracts were always enforceable in London or the US, and basically that's it. No civil law country, only common law countries, and basically only the US and UK with arbitration outside. The first thing private equity firms do in China is take the companies to the Cayman Islands. I don't know if that's still true, but the institutional quality funds, that was very, very normal for years. So this institutional development, I cannot stress how important it is. And I also think that it is, and we can talk with Eddie about this, it is the thorny knot that's at the base of the self-contradictory reform program in China that they really have to figure out. Can they have the Holy Trinity, which is going to be a problem, I believe, more on the capital account. Every country that's prematurely opened their capital account is at a huge financial crisis. So I agree with Eddie, the most proximate crisis is in the currency, but the big kahuna would be a premature opening of the capital account. And again, do you have a legal system? Does China want to have a legal system that's impartial, that's fair, that's well known, where the laws are known, et cetera? These are all, I think, it's just China's so much bigger and so much more powerful that it serves as an example. But every emerging market has the same issues. Maybe Italy has a few too.
I think you can find other issues, similar issues in non-emerging markets.
And I think a lot of people in the US we've heard today were all complaining about some similar things.
It's a matter of degrees. It's a matter of degrees.
Matter of degree.
So by that definition, by the Bremer definition, I wonder where some countries end up on that balance. So yet, one of the things that I think we want to talk about a little bit as well, and then I'd like to open it up to the audience, is sort of, the theme of this conference is very much a sort of finance as a tool for, tackling, social challenges, right? Social issues. There's sort of one view, which is, a lot of the problems that we're dealing with in some developed countries around income inequality job insecurity or sort of growing economic insecurity, in fact, has to do with sort of this market-based view and or market-based financial system that sort of favors short-termism and sort of huge rewards for those who invest well. Yet there is a very different view, and I think your work was sort of perhaps exemplary of that, and I'm sure both of you have encountered this as well. This sort of notion that in order to create jobs, to create insurance, to create educational opportunities, you really need to build these kind of market-based financial systems. So I'm curious if, we've talked about financial system and government, let's bring in society a little bit more, and your perspectives on the role that financial systems in emerging markets in particular serve or can serve in helping address some of the big social challenges. Go ahead,
so
please.
what do you, Paolo?
Yeah.
It's easy, it's a subject where it's easy to be biased, and it's difficult to have a lot of data to back one position or the other. But the only thing that I would like to say is that depending, if I have to look at my experience, I haven't checked recently, but if I look at Europe, I think that the Gini coefficient is very high in Portugal, is very high in Italy, is very high in Greece. And I will rate these countries' financial industry among the least developed in Europe. So I'm not sure that there is. I'm not sure that there is a correlation between the development of the financial services industry and the inequality that you have in society. So I am not sure that also that there is a strong correlation between the development in the financial services industry and the quality that you have in society. I simply think that the problem of inequality it's made by a lot more variables, and it cuts across the way ownership, property rights, capital, how you apportion the rewards for which type of talents. And I think it is not. Financial services. We should see financial services as much as any other industrial industry.
Well, I mean, let me speak in the context of China. Well, I think is really very clear that the development of, in particular, capital markets are extremely important, because one of the key issues for China is obviously the over-concentration of capital, power, and risk in the traditional commercial banks. So over 90% of all the capital come from the banks. So the capital markets, both equity and especially debt capital markets, are way underdeveloped. And that exacerbates also the so-called local government debt problem, because traditionally Chinese municipal governments are not allowed to issue municipal bonds. So they jump through hoops to create these platform subsidiary companies to borrow from the banks and build the bridges and do whatever they want to do. So I think it's really of paramount importance that China does not get completely derailed by the recent events in the development of capital markets. And also, I think especially for China, I know we're going to talk about that later, but I think they see the advance of especially you call it fintech or online financial services as a chance, much like in the cell phone itself and in areas such as renewable energy and electric vehicle, as a possible opportunity to leapfrog the West, to catch up and to go beyond what the West has done. So indeed, in the West, you see companies like Apple, stopping at Apple Pay. They neither want to replace the bank nor even the credit cards. Of course, they're the world's largest company. If they want to give a run for Visa's money or MasterCard, they can. But they choose not to. They choose to insert themselves merely between the banks and the credit card companies. But the leading internet companies in China, such as Tencent and Alibaba, of course, are all making bids to become online financial giants themselves, with money market funds, with banking licenses, even very innovative online insurance services and so on. So they see it as an opportunity, actually, a lot of these financial services as a way to catch up and to catapult themselves to be the leaders. I don't know whether these financial services are necessarily exportable, much like what Teresa said. I think financial services is an inherently very domestic-oriented business. But I think in terms of business models, in terms of technology, there's some very, very promising initiatives that the Chinese are doing. So I think it's definitely, finance is seen as an opportunity and a force for creating, social changes and other things. And if you can manage to delever the Chinese banking system sufficiently, I think that is also social good, among other things. And not only that, but you kind of, give a little bit more power, obviously, to the markets and to the private sector, which, in the Chinese context, it sorely needs. I think China, to be honest, is unique among developing markets in the sense that even if you ask most Chinese people and business people, up to maybe a few months ago, they all acknowledge the positive role that the government has played in terms of, infrastructure investments and enabling certain industries or seeding or assisting them in some ways. I mean, with a lot of restrictions and blemishes and maybe favoritism, nepotism, corruption, whatever. But for better or worse, it stands in stark contrast with the answer that a typical, say, Indian businessman would give you. An Indian businessman often will tell you, even a successful one will tell you that they've succeeded in spite of the government. So up until now, most Chinese businessmen tell you that they succeeded with the help of the government. But I think what a lot of people are questioning now is whether that will still be the case going forward. Will the government be a positive force to help them? Or will they actually also, like other emerging countries, stand in the way of development? And I think if they manage to develop more capital markets, more financial services, giving the market the important role, the decisive role that the government promised just a few months ago, I think that would be good. But the recent market turmoil has given a lot of investors the impression that they may be rolling back some of these reforms and may not be as firmly committed to the reforms as previously thought. I think that's really what's scaring a lot of people.
You're thinking about this a lot. Yeah.
Well, I was just going to go back to this plutonomic disruption in the world. And I actually try to ask the audience, because I think there are probably people here who have a lot better prescriptions. But as I go around the emerging markets and I listen to the presidential debates, such as they are, in the US, this income inequality, which is growing in the world, has been growing in the US since 1965, we do see real effects from it. So we see very often it ends up in populism, xenophobia, authoritarianism. We saw it in Brazil, which has a Gini coefficient of 53, you'll be interested to know. And where Lula was elected on a populist platform, Dilma comes in again on a populist platform, and became very protectionist, put in lots of industrial policy, most of which had the effect of bringing 40 million people into the middle class, which was great, but also creating a system where they distorted the interest rates through government lending, where you had lots of protectionism, so you couldn't have imports, where companies had a bigger bang for their buck spending on lobbying the government than on R&D. You had full employment, no slack in the system, inflation raging, and then, of course, the terms of trade turned against them. So it was been a total disaster. And the same thing in Chile. Excellent country, terrific, but a lot of people concerned that they had the second worst Gini coefficient after Brazil. And so they elected Bachelet, who brought the Communist Party into her primary. She didn't need that. She won with 72% of the vote, and then had a very populist agenda. At the same time, terms of trade turned against her, and now she's on her third cabinet, and it's pretty much to become a dysfunctional. politics matter more than economics when you have this movement. I think that this response to plutonomy in the world can also be another response, which is more transparency and an effort to do more for the people. And I think we see a little bit of that in the Philippines, where the government became more transparent, a little less corrupt, and tried to build more infrastructure for the people. So you can have another response. But who knows what the right response is? You know, is it through taxes? Is it through education? Is it through industrial policy? And I think we probably have experts all over this room who could have a great answer to that.
You're doing this much better than I could. So let's open it up to a couple of questions or comments on, please, all the way in the back.
Hi. Yeah, you guys kicked off this
If you
session.
could introduce yourself very quickly.
Oh, I'm sorry. My name's Julia Ott, and I'm a professor in history of capitalism at the New School. So the discussion, when we started off, raised the issue of finance's relationship with society and the political economies in which they exist. And I'm wondering your guys' thoughts if we sort of relax our assumption about the division between sort of finance and government, or finance and the state, and think about new developments like sovereign wealth funds, which I think are very important contemporary phenomenon that will only loom larger in our world financial system in the future. You know, what are your guys' thoughts on that? What's your take on sovereign wealth funds and what might be coming in the future?
It's the government as investor.
I've looked at them a lot. Of course, the best one was designed by, whoops, you okay? The best one was designed by an Iraqi, of course, which is the Norwegian Sovereign Wealth Fund. So, you know, I always put a plug in for Iraq where I can. But I think when they are like the Norwegian fund, or like ADIA or ADIC in Abu Dhabi, I'm not so familiar with KIC maybe in Korea, and they are really there to get returns for the long run, and they're very clear about asset allocation and what they are there for, returns on their investment, with then some conditions. So for the Norwegians, corporate governance is a big condition. For the Abu Dhabi, less so. For others, probably environment will be some conditions. But mainly it's focused on return. They look indistinguishable to me from university endowments.
Totally.
You agree with that?
Yes, not only. The Norwegian one only invests in public equities. So when they invest in equity, they've got to be public companies. And so you are dealing with a Norwegian, dealing as a client with a Norwegian wealth fund. It's not much different than dealings with Fidelity.
Yeah.
Now, if you're dealing with the funds of the government of Singapore, it's a different story, but not because they are, simply because each one of them has a different mission, and some of them only do private equity, some of them only do infrastructure financing, and some of them only do public equities. And so we are talking about, we call them sovereign wealth fund. I have to tell you one thing, I don't see the sovereign except then in the influence on the way they are run and the leadership and in the themes that I have, but I don't see much of the difference but
well,
I mean, it's good. And I have invested with some of them, so not personally. I have done a reasonable amount of deal with some of them, and actually we as Goldman are invested with one of them in Italy, significant investment, and honestly it's not different from being invested with Fidelity or with KKR.
My perspective is that I think, they some of them are quite well run, and they are very economically motivated. But I still have the question, what good do they do for the society and the country involved? Right? Are they really, saving for the future? Are they providing the returns to the people? And then coming back to China again, of course, they are trying very hard to develop their own sovereign fund. There's numerous of them, CIC, the SAVE, the Foreign Exchange Fund, and so on. And closer to home, they all want to mimic, the Singaporeans, which is a very small city-state. They want to develop their own Temasek, their own GIC, and so on. But unfortunately, they fall way short of. Again, I mean, I have issues whether Temasek and GIC are doing a lot of good for Singapore, but that's aside. But the way the Chinese are trying to do it just doesn't work. Singapore and Hong Kong are famous for having relatively clean government because they pay the people really well. Whether it's right to try to attract the elite into the government is a different issue, but I think especially in the case of Singapore, they give them scholarship, it's very prestigious, and they pay them as well as in the private sector. But in China, on one hand, they have passed laws for giving out ESOP, which is encouraging, right, to give incentives to employees. But at the same time, they've actually not only enforced, obviously, anti-corruption very severely and very sustainably, but they've also cut the already very low salary of the top manager of a lot of the SOEs by 30% this year. So it just doesn't square. You're paying a guy 7,000 yuan, which is like a bit more than 1,000 US a month, managing as big as like a $2 trillion US company or like a bank. And then they're supposed to go out. Supposedly, the manager would take a step back and they become financial investor like a Temasek or like a Norwegian wealth fund, and then hire market professionals to manage the company and possibly pay them, maybe $5, $10, $20 million a year. They go crazy. It's just not going to happen. The guy who's paid $1,000 a month is not going to hire the right people to do it. They will only hire their cousin or somebody who would cut a deal with them to do it. So that's the reality of it. It's just, so the track record of the CIC, the Chinese sovereign funds, are not nearly as good as some of these other ones.
Let's see if we can, if there are more questions somewhere. There's one back there, and then we'll try to come down here. Yes, is there a microphone right up there? Thank you.
Hi, I'm Jubin. I'm a student at Yale School of Management. I just wanted to understand, emerging markets have fueled the growth over the past decade for much of the world. And now as emerging markets slow, where do you see the next wave of growth coming, for whether it's for the pool of capital that exists in the developed world or for corporates who have a lot of cash on their balance sheet? Do you think there'll be frontier markets, or do you think they'll be more domestically focused, especially in the developed world?
You've silenced our panel.
You should read the McKinsey report that came out today that said that the golden era of corporate profits from 1980 to now will disappear. And one of the reasons for that is that you're now getting a very strong minority of a plurality of the top Fortune 500 companies are from the emerging markets, and they're willing to take lower returns. So the real question is, are we losing ROIC discipline? And are emerging markets companies willing to compete at lower ROICs? We have seen the return on invested capital in emerging markets come down in the last 2-3 years. And the whole question was, is that structural or is it cyclical? When you look at the analysts' predictions, everyone is predicting a better top line for next year. So better GDP growth and better revenue growth for companies next year, but maybe it's always easy to predict that next year is going to be better than a really bad year, 2015. So I don't know. I mean, I read the précis of the McKinsey report, and I was quite skeptical, partly because a lot of those companies are state-owned enterprises, and a lot of them are Chinese state-owned enterprises. And as China goes through SOE reform, will that change? And if they go from having a double, triple, quadruple bottom line to having a single bottom line, which is return on invested capital, then will that problem be self-righting? And so you should read the report. It's out today. It's available. I don't know, has anyone read more than I have? I just read the précis. You read the whole thing? So we'll see. I think the jury's still out. Our companies, we only have a concentrated portfolio. We invest in 20 companies at a time. We look for very high ROIC companies, and it's only in the emerging markets that I see EPS growth of 30% per year visible for the next 3-4 years, 40% per year visible for the next 3-4 years. And I would say mainly the country we see those very high EPS growths in is India. When you get a company with a moat, if you get a country that's highly competitive or where the conglomerates that control the whole economy, the oligarchs, have decided to go for market share, you'll see a deterioration in ROIC, which we saw in the Philippines last year, and it's righted itself this year. So we'll see how these things go, but for my money, I'm only seeing EPS growth and ROIC really in very few countries, and so the jury's out for 2016, 17, 18.
I think GDP growth and earnings growth and stock market performance are nearly uncorrelated. In the Chinese context, I've done regression analysis, it's actually quite strongly negatively correlated. So actually, prima facie, the slowdown in Chinese GDP growth is very, very good news for earnings growth and very, very good news potentially for stock market performance. It's minus 0.6 for people who are interested over the last 10 years plus. So I think the new normal, if China slows down, if they don't grow by just, over-investment in obviously fixed asset and certain things, and focus more on the bottom line, on controlling costs, revenue. Obviously, as Teresa mentioned, focus more on shareholders' value. If they can align the interests of the management better with the shareholders, I think, lower GDP growth is definitely very, very good news. It's not a causality. Maybe it's a coincidence, but there's, I think, primary evidence that slowdown in, of GDP growth in China is a necessary, if not a sufficient condition for better returns on equity and better stock market performance.
So we only have a couple of minutes left, and we have a lot of students in the room here. So allow me to sort of put on my dean's office hat and say that a lot of our students are interested in this space, and this space being the intersection of finance and global business, emerging markets, investment towards achieving a broad set of objectives, financial objectives, as well as perhaps social environmental objectives. So as 3 Yale graduates who've thrived in this odd space where politics trumps economics, as you call it, what are your thoughts on this? What are your recommendations for current students thinking about this space, broadly conceived? Where should you apply yourself? How should you apply yourself? I think they should
invest in 2001 and get out of the market in 2007.
Excellent. All right. So we can't let you off the hook quite as easily.
Hard to say. I would say if you are, but you know my answer already. I would say if you are interested, but you might decide that it's an obsession of mine, and you're probably right. If you are interested in financial services and in this space, try to look at the characteristic of the financial institution. Look at them very closely. Look at the way they operate in different countries. Look at the way they operate across countries. And if that's your interest, in my opinion, you will get a pretty good picture of the interaction between financial services, politics, and society. I think you probably will get it more looking at financial services and analyzing financial services that you will get it with any other industry that I know of. If that's your interest, that would be my suggestion. I would say that is probably the area where you will find the closest interaction, the more interesting interaction than in any other industry.
Your thoughts on this, Eddie? Yeah.
Well, I think, assuming the world doesn't blow up, right? I think that's a...
Yes, that's the assumption.
Yes, there are very exciting opportunities at least in the space I work in, right, all over Asia, from Japan to Korea to mainland China to India and so on, and I think all the problems are somewhat generational. I think a lot of the craziness that you see in China and in other countries are more to do with like the older people, who have gone through, certain experiences, especially in the case of China, Cultural Revolution. The people from that generation are in charge, and they're a particular ilk, right? So I think the younger people I meet here and elsewhere in Beijing, Shanghai, they're quite normal. I think they are subscribing to the global values, and a lot of them have traveled and have international education, and a lot of them, obviously a lot of our grads have gone back to China and have done extremely well. So I think there are lots of opportunities, especially like the convergence of technology and finance, and the last fortunes were made in e-commerce, in social media. I've no doubt that there will be some fantastic fortunes to be made simply in fintech and online finance. I mean, I'm familiar with a couple of them. Some of you may have heard of them. This morning people talk about Uber. That's now valued at $50 billion. I think some of the largest so-called unicorns in the world are Chinese, and of course one of them you may have heard of is a Chinese phone maker called Xiaomi. So that's roughly $50 billion. But there are a few which are going to surpass probably Xiaomi and Uber very quickly. One of them is called Ant Financial. It's a subsidiary of Alibaba. That's roughly valued at 40 to 50 billion already. And then there's another one. It's a subsidiary of a very large insurance conglomerate in China, Ping An Group. They have a subsidiary called Lufax. It's headed actually by an American. And that's going to be like worth 20, 30 billion. And then, of course, also Tencent, now actually suddenly the largest internet company in Asia because of Alibaba's drop. They have actually applied and successfully gotten a banking license. So they have a subsidiary called WeBank. And also, there's a joint venture between Ping An, Alibaba, and Tencent. It's the first purely online insurance company in China, probably unique in the world. They do really funky stuff. Some of the things that kind of like Professor Sheila was talking about, that weather insurance, if it gets beyond 33 degrees Celsius a day, then they pay you something, right? You can buy insurance and that. So it sounds almost like a London bookie, actually. It's called Zhong'an Insurance. And they've raised one round of private equity financing through Morgan Stanley, not Goldman, earlier this year, valuing the company.
Hugh's happy over there. This is the second time he's called out Morgan Stanley.
The company is valued at 8 billion already. So like in 2 years, it's already gone to this magnitude. So I think there'll be more opportunities popping up. There are thousands of peer-to-peer lending companies in China. 90% will go away. But there will be survivors. There will be people who come up with even more innovative technologies, which will help the people, help to develop the capital market. So it's actually very, very exciting.
I would just say, as a general matter, if you're for your students, absolutely work in emerging markets, because it's so much more interesting. Because the institutions are not developed, you can be part of developing those, strengthening those, testing those. So I think that's absolutely right. I think that you should learn languages, without a doubt, and you should also have a lot of friends. I'm allergic to people having contacts and networking breaks, and I just hate all that. But I have a lot of friends who I've worked with over the last 20, 30 years, and I can call them and say, what do you think of this company? And having really good friends whom you trust, whose judgment you know them well enough to understand their own integrity, that's really key, because when you don't have an institutionalized market, you then need to know who it is you're dealing with. In the emerging markets, in the listed space, 85% of all companies are controlled by a family, a founder, or the state. So I don't like to invest in companies owned by the state, but that's 15%. But the rest, you've got to know that family and that founder. So you need to have friends whose judgment you trust. So that would be my advice, and absolutely it's so much more fun than like US, which is very boring.
There you go. So it seems we have three conclusions, right? Emerging markets are interesting and fun. The basics matter a great deal, and we shouldn't be surprised at the next wave of innovations, shaping the future of finance, will come out of emerging markets. Thank you so much to all three of you for these wonderful insights.